Now, in our last episode, we discussed the market conditions that led IBD to get cautious in late February before the stock market sell-off began and before it turned into a full-on crash. Today, we're going to walk you through the technicals that we always look at during market corrections that signal an improving investing environment, which we're now starting to see in this market that's in rally mode. So first, just a reminder that when a market is in a correction, that's not the time to aggressively buy stocks and try to guess where the bottom is. Instead, you want to protect your portfolio, be on the sidelines, and wait for a new market uptrend. That means that during corrections, investors should be updating their watch lists with top-notch stocks that are setting up, and be ready to dip their toes back in the market waters once we see what we call a follow-through day. Now, IBD's research shows that every new market uptrend begins with one of these follow-through days. And in order to find a follow-through day, you first need to see a stock market rally attempt. So let's take a look at a chart of the S&P 500 to see this concept in action. Now, day one of an attempted rally begins when at least one of the major indexes closes up from the previous session. For the S&P 500's current rally, that day was here on March 24th. Day one can also be what's called a pink rally day, and this happened on March 23rd for the Nasdaq when we saw a close down on the day, but in the upper half of the bar. And the rally will continue as long as the absolute low for that index holds. Also key to note here is that you don't want to buy on this first day of the rally. Instead, you observe and wait for a follow-through day, which is at a minimum of 3 days after this initial rally day, and it's marked by a gain of at least 1.25% in volume heavier than the previous session. And flipping back to the S&P 500, we saw a follow-through day on April 2nd, when there was a solid price gain and higher volume on the New York Stock Exchange. That prompted IBD to upgrade market conditions to market in confirmed uptrend. But we noted that this follow-through day came with caveats. All of the top percentage gainers for the S&P 500 that day came from the beaten down oil and gas industry. Typically, in the early stages of a new bull market, the strongest leadership comes from stocks breaking out of well-formed bases, not stocks near 52-week lows. But then, if we fast forward to April 6th, we saw a compelling follow-through day for the Nasdaq with a huge gain in heavier volume. It was bullish for the tech-heavy index to retake its 21-day exponential moving average. That's the green line here. It was also encouraging to have a close above the intraday high set on March 31st here. It would be ideal to see the Nasdaq hold both of these levels moving forward. Now, even though we are in a confirmed uptrend, this market still has to prove itself. Breakouts are still in relatively short supply, and the major indexes remain well below their 50-day and 200-day moving averages. Also, after a vertical violation, which is what that extremely sharp sell-off we saw was, our research tells us that the first follow-through day has a higher chance of failing, meaning it's important for investors to remain very vigilant. So make sure that when you're buying stocks cautiously out of proper setups, you are watching them closely and following IBD's sell rules. Remember, this is still a very volatile market, but IBD's experts are tracking and analyzing current conditions each and every day. So make sure you continue to check investors.com for the most up-to-date market insights.